is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the market highlights for this week. Well, the ECB and the Bank of Canada met last week, and the message from both was the same. We're on hold for now, but we'd like to ease further. There are three central bank meetings this week: the Fed, the Reserve Bank of New Zealand, and the Bank of Japan. The focus will naturally be on the Fed, which is looking for reasons to move in the opposite direction, but the market expects that in the end, all three will remain on hold. Other highlights of the week will be the first fourth quarter GDP figures from the UK and the US, the German and EU CPI for January, and the usual end-of-the-month data deluge from Japan. So, a few of the highlights of the week will be: on Monday, the German IFO survey expectations index is expected to decline, as did the preliminary German PMI for January. This could add to evidence of a slowdown in Europe's biggest economy and be negative for the euro. On Tuesday, in the U.S., the Conference Board Consumer Confidence Index is seen as improving slightly. So far, though, strong consumer confidence doesn't seem to be translating into strong consumption. On Wednesday, all eyes will be on the FOMC meeting. Since they moved in December, the U.S. economy has slowed, financial conditions have tightened, and financial markets have fallen sharply. The FOMC will have to acknowledge these changes, but it's way too early for them to suggest that rates may have peaked, much less that they might unwind the December move. I'd expect them to stress, as usual, that future moves depend on the data, not the calendar. A neutral comment could be seen as quietly acquiescing to the market's expectations that the FOMC is overly hawkish and could therefore be negative for the dollar. The RBNZ also meets on Wednesday, according to GMT time. It's Thursday morning in New Zealand. I think it's unlikely that they'd cut rates so soon after cutting 25 basis points in December, especially after they said in their statement that they expect to keep rates stable from now. However, with China's growth slowing, milk prices edging down again, and New Zealand prices falling on a quarter-on-quarter basis in the fourth quarter, another cut this year, sometime this year, looks likely to me, with concomitant weakness in the currency. On Thursday, the UK announces its fourth quarter GDP figure. Growth is expected to have picked up slightly on a quarter-on-quarter basis, although that would still be a slight slowdown on a year-on-year basis. That might further knock back the market's forecast for when the Bank of England can start raising rates, which is currently November 2017, and weaken the pound. Now, Germany's CPI is always closely watched as a precursor to the EU-wide CPI that's announced a day or two later. The renewed fall in oil prices is likely to keep consumer prices under downward pressure. Although in January, the base effect may mean a small rise in the year-on-year rate in Germany for the month. An acceleration in the month-on-month rate of decline could be negative for the euro. And on Friday, the Bank of Japan meets. There's some speculation that they could ramp up their monetary stimulus. Now, Bank of Japan Governor Kuroda's often stressed the importance of higher wages, which provide the fuel for higher domestic demand and higher prices. But the round of wage negotiations that's now beginning has shown neither labor nor management aiming particularly high. Bank of Japan officials still insist that inflation is rising, but the weak wage demands demonstrate that the population doesn't really believe them. Moreover, the yen has started strengthening again, and industrial production is flagging. The Bank of Japan can move now and hope that they influence the wage negotiations, or it can wait until April when the results of the negotiations are known. Personally, I expect them to join the other central banks that have met recently and decided to wait and see, which could cause the yen to strengthen. Finally, U.S. fourth quarter GDP is expected to confirm the slowdown in the U.S. As usual, a lot will be made of the erratic weather: too cold one year, too warm the next, slowing consumer spending, a decline in net exports due to the stronger dollar, and a fall in business investment are likely to add up to weaker growth, but it doesn't yet spell the end of the recovery. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.